Welcome to the Farm.com Risk Management Educational Commodity Marketing School video series. This video series is being brought to you and sponsored by DeKalb Brand Seed to educate producers and farmers about grain commodity marketing. This is the second out of 26 video series that will appear throughout 2011. In our first video series, we spoke about how grain prices are determined. Today, we're going to look at risk in agriculture commodity markets. We're going to look at all the different components within that price risk. Price risk is your biggest risk when it comes to grain marketing. What you ultimately receive at the end of the day will determine whether you're a poor or a very good marketer, and ultimately whether you're going to stay in business as a farmer. Remember, you can't predict the future, but you can manage the risk and volatility. This is an example of risk. This is the 2008 December corn futures chart. Would you rather sell at $7.50 a bushel or $3 a bushel? Risk is not that corn was going to go to $8 or $9 a bushel, but rather, was it going to go back to $3 a bushel? And it actually, in fact, did do that. We now look at the effects that fluctuating prices have on your farm operation. What is price risk? Well, price risk is, again, in this example, we've got soybean futures for 2008. November futures contract went from $16.50 a bushel to $8 a bushel within, again, a 4-month period. Price risk is the chance that a selling price or a purchasing price is lower than expected. So you expected soybean futures to go to $18 a bushel, yet it went back to $8 a bushel. And if that was lower than your cost of production, that was a price lower than your expected selling price. This can lead to a gross margin risk. In this example, we're using canola November 2008, when futures went from $7.50 a metric ton to $350 a metric ton, again within a 4-month period. Gross margin risk is the chance that gross margin is less than expected. Gross margin is the difference between the selling cost and the cash or direct cost of producing that unit. Cash flow risk is the chance that cash flow might be negative. Finally, financial risk is a chance that the farm operation may not meet its debt requirements, whether it's operating or long-term debt. So let's go through a quick example here with soybeans. Let's assume in this example that soybeans are currently trading at $12 a bushel. The yield is 40 bushels per acre, and it's going to cost us about $375 per acre to grow this soybeans. So your price risk occurs because the actual price is lower than what you originally thought. You had a chance to sell soybeans at $12 a bushel, but in fact it came down to $7.50. Margin risk happens because the lower price turns into a negative gross margin, which translates into a negative cash flow, and then eventually into a financial risk where that negative cash flow doesn't allow you to service that operating or long-term debt. In this example, we're using canola. So in this example, we're assuming canola is currently trading around 600. Your yield is 0.9 per metric ton per acre, and we got a cash cost of approximately $409 per acre. And again, in this example, price risk occurs because the actual price fell lower than what you expected. You had a chance to sell at 600, but it then fell lower, which again creates a gross margin risk, a cash flow risk, and then eventually a financial risk. And all of this really matters, and you should have very good records. One of the keys, and we really won't get into too much detail today about cost of production, but having a very good idea of cost of production and having good records about your inputs can help with understanding where that price risk should be, where that profitability stands at any given point in time. Understanding your cost of production, having those good records, is critical in managing your input risk and price risk. Chicago does not care what your cost of production is. This is a prime example of price risk, and it's about a 39-year chart of hogs. This is a very long-term continuous chart, and you can see the volatility from the highs to the lows. And those who manage the risk will ultimately stay in business. Those who do not will experience a lot of lows. in terms of that price risk, and in many cases in the last few years there's a lot of cattle and hog producers who are out of business because they refuse to manage that risk. It's like the old saying goes, bulls make money, bears make money, pigs get slaughtered. No one ever gets hurt taking a profit. In this example here, we're using oats, okay? And you can see in 2008, this is the December 2008 futures contract, we went to $4.89 a bushel and eventually down to $2 a bushel. Again, that's a lot of risk. Knowing your break-even levels, depending on average yields, will help you identify those profits. So at $4.89 a bushel on oats, can that make you money? How much is on the table? Translating that into dollars can really help to understand what you're leaving on the table. Remember, Chicago prices mean nothing until you actually pull the trigger. In our next video series, we'll look at the factors that cause volatility in grain and commodity markets. Thank you for spending some time with us today. We hope that we've shed some light on price risk and what effects it can have on your farm operation. We look forward to seeing you next time.